Hello and welcome back. This is David from the Personal Finance Squad. We just finished with chapter 6 and 7 where we spoke about the FSA and the decap accounts. And the main benefit to that is that money for those accounts are taken out pre-tax. And so as we'd like to say, that leaves more money in our pockets and not someone else's. Now we get into credit card management where that's different. We borrow money and a company, an entity, will add interest onto that, and it's cycling interest, so it doesn't have an end unless you make it an end. That interest is added every month unless you control it. Okay, so I think the biggest thing with credit cards, it's like this saying you may hear a lot of people say is, I'm gonna buy now and pay later. And that makes a lot of sense. It's a lot easier to swipe a card and not think about it because it's probably just convenient. I saw something on TV recently where a woman was given $1,000 to spend her groceries as opposed to $1,000 with her credit card as per normal, and they found that she saved about 20% because psychologically she was touching the money and she thought a lot more deeply on the purchases she was going to make. And I think their studies on other areas pretty much concluded on average that's about what it seemed to be with people. So it is interesting in that regard. It just tells you don't always need as much as you think you do, or you're going to think thoughtfully about what you buy before you just go hit the card. But in reality, credit cards are part of life. Harder for younger kids these days, millennials with student loans, or at least the debt part, or they don't, it's harder for them to get the jobs in the hole to make the money to live. That's why they live at home longer than typically in the past. 3/4 of all Americans can't afford to retire. That's what I was getting at. And one reason is for that, credit cards. So I just pulled this right off the net. You can find all kinds of studies about what the average debt is, but typically you're going to see the same types of numbers, and $15,762 in this case, or almost $750 billion. It's hard even to fathom what $1 trillion really is, even if you understand math and digits. To actually see that kind of money would be outstanding. And you can see things with like mortgages are listed here. They're a little bit different ball of wax, which we'll cover those later. Auto loans we just spoke about briefly, but these are AMOR, amortized. Student loans, $48,172. That's 3 times the credit cards alone. So even though student loans, again, they fall under this type of a payment schedule, the whole point is debt is out there and most Americans are not managing it right. So this is why we're going to make sure that you guys really understand and see how interest adds up, and hopefully it grinds your gears to say, I'm going to do everything I can to avoid this. One important thing, again, when we talk about amortization is like, yeah, the way the structure for these types of loans are different. So with a student loan and a car loan, they accumulate interest, but it's on a schedule. It's the same monthly payment, and you have an end period. So a mortgage is typically 30 years. A student loan could be 10 or 20. A car loan could be 5. It varies. But you know what the end date is. So the interest is already baked in, and you have the ability to knock down interest by the more principal you pay over time. Credit cards cycle every month. So they cycle monthly. So long as you're leaving principal balance out there, there's an interest rate, and it's going to add interest, and then that interest goes onto your principal balance, and then it just keeps cycling until you pay it off. But the thing we like to think about here is the whole point with credit cards, if you have to put something on there, it means you obviously can't afford what you're buying. And that takes away from disposable income. That's the leftovers. That's what we talk about. So when Jasper's done with his budget and he has, let's say, $800 a blow a month, that disposable is gone. And then if you can't use that disposable, then you're going to dive into other bills, or if you can't pay for your stuff, that's why they go on credit cards. So again, we'll get into this a little later. Just kind of want to throw some numbers out there and just some basic thought process. I'm going to be drilling this in your head over and over about how credit cards can be very dangerous. The way I think about it, credit cards are, in a lot of ways, are debt on the whole for Americans. Is really like an epidemic. Here's the deal though. You need credit to have a credit score, and credit scores allow you to borrow money at better rates. And you might be somebody who says, I don't use credit cards. You might hear a few people say that, and that may be true, but have to. So most people on the whole are going to have some form of credit. Now that could again be in the form of a car payment, could be a house, could be a boat, could be a furniture store card, could be clothing. Let's say we pick like Target. So you could have a Target card with only a $200 limit, but it's credit. And the whole point is you're going to get judged, and you can see some ranges in here of what is going to constitute better rates. So that's all variable based on the institution lending you money or the credit card giving you the available line of credit to spend. But you can see in here that for the most part, if you stay right in here in this upward area, you should be able to achieve pretty decent rates. Now, the only way to really know what one rate over another rate, if you're going to get a better rate in this range, even if you just have this score, you're going to have to call around because everybody's different. That's why you have to shop before you buy things. But you certainly know you're at the top of the scale here. So then you get down here, and the lower you go, the more vulnerable you become because you pay more. So you could pay for a car payment interest, let's say it's 5.5, but if you're down in this land, you might be getting to 6, you might be getting to 12 or 13. Could be higher, just depends. And if you have any bankruptcies or big marks on your credit score, they'll get picked off, and those lenders are going to ask you to pay more in order for them to let you borrow money from them or get a possession such as a car, right? If it's straight out of a dealer, for example. But the whole point is you have something you want to buy or you have a line of credit, and they're going to charge you more for it. And this is the kind of stuff right in here where when people get vulnerable is where the predatory lending began. That's where the mortgage company said, listen, I've tapped out all the people who are good credit borrowers. So all the new homes or the refinances. So they wanted to make more money. So they preyed on these folks in here who were vulnerable and would be furnished with exotic mortgages and things they didn't understand. They eventually would start off with low payments and they would balloon because they didn't understand what they were getting into. And eventually these people started defaulting on mortgages because they couldn't afford to pay what they had. I don't want to get off on a tangent here. I just wanted to point out some basic things in here and understand that this all gets down to the same thing. If you can't afford to buy something, you put it on credit. The more you do that, the more you're taking away from money that you have. So you try to buy things that you can afford and do not charge them. At minimal, I want to say one more thing is, people borrow money. It's okay. It happens around the world. The GEs of the world will issue $10 billion in bonds. And then people buy them. Probably more like institutions, but people purchase. And GE pays a rate back. Now that's a high big example or a loose term, but the whole point is everybody buys. Most people in some shape or form, even the rich people, tend to borrow money in some shape or form to benefit them. But the average American is going to have a house that they're going to pay, and they're going to have a car, and they're going to have certain things. And not going to afford to pay those, of course. You're going to have some debt. Most people do. It's understandable. You just got to try to stay away from the credit card side of it, first and foremost, and then manage your consumer loans and don't get those out of control. The whole point, as we always say, is you have to afford the things you are paying for. And if you can't, you need to make adjustments in your expenses. And if you budget and plan out over time and get very mature with these budgets like we do, you should not fall into that trap. A couple of things just to go through for those of you, maybe you're a student, not so much someone in the working world who may know some of these things, so we'll just glide through them. But certainly some factors that affect your credit score. Certainly bank accounts, things that credit bureaus are going to find out about you. They're going to get some kind of algorithm, some kind of computer thing that puts all this information together, decides what kind of rates you can get or how they score you, things like that. If they're hitting the banks, they're going to know that maybe your bank account is good. It might just be a number or something that says, yep, the good standing account. You might get a letter grade of an A, or another guy might get a D. Employment history. They're checking into this, and then they're going to say, you know what, if this person's a consistent worker and been at their job for a long time or stays employed with stable income, that's a great thing. If you see it being very choppy, that's a mark. Certainly residence history, a lot of lenders want to know, it's kind of the same pattern. These are all the same patterns for the most part. You've been in the same residence for a long time, so that means you've been, with no marks, you've been making your payments, you've been in a sense a steady customer to the mortgage company. It's risk adverse to the companies. You're your better bet. Or a weaker bet, but then that means your score is going to be higher or lower rather, and then you're going to get charged more for an interest rate when you do borrow. Now, a good point here is to look for the bank. If you don't have credit and want to establish it, or you do have credit and you want a card through your bank, there's a good chance if they know your history, so nothing wrong with trying to stay in your backyard to get this to get a card. Nothing wrong with that. My wife and I have one through our bank for that very reason. So store cards, we kind of mentioned Target up there. You can certainly get lower credit limits with cards, and anywhere you have credit, you're going to be checked. So if you get a mark on your card, whether it be Kohl's or not making a payment even on your car payment or just your general Visa, it's going to get noted out. The credit bureaus will find it because they get reported by these institutions. So Target would say, you know, David is 30 days late, or has one 30-day late, something like that, and that's a ding. And they see things like that, and they add up all these things with a bunch of other factors that I don't think anybody understands. But the whole point here is to stay consistent, make your payments consistent with everything where you live, your bank, all these things, all these factors. If you look solid, you're going to get, again, better rates. Finance, we'll push this down a little bit. So finance with a store purchase with the same as cash offer. So let's say it's the furniture store, company XYZ Furniture. So what they're saying here is, you know what, David, I'm going to give you $500. And so I have a credit line. And you're in our store today, so we have 50% off. And if you buy today, we'll give you 6 months, same as cash. So what they're saying there is, I owe $500. I have 6 months to pay it off. Which is to say, if I pay it off in 6 months, I don't owe anything but the $500. But what happens is, underneath the scenes, during this 6-month period, they're accruing the interest as if you really owed it. Excuse my spelling here. Let's fix this up. So they're accumulating it. So they kind of keep it like a little cube, so to speak. So let's just say the interest over 6 months' time is $400. So you don't owe that $400, but when you get to the 6th month, if you are $1 short even of that $500, they're going to say you're going to have to pay that $400 on top of it. So let's just say I'm $1 short, and I ended the 6 months with a $1 balance. They're going to go, well, you didn't make the mark, so all the accumulated accrued interest that we were holding, now it's getting added to the account, which means now you owe 401, or I would owe 401. So you have to be careful with things like that. It draws a lot of people in because it is enticing to say, hey, I can get a break for a little while before I have to pay anything. But on the end of it, again, if you don't pay it, you're still going to owe it. And it's a big shock. All of a sudden you say, hey, this looks like a $400 charge all of a sudden, when you were so close. Or even if you had a balance that was manageable, you got to make sure, again, you can afford what you're buying. But it's a nice way, if you have the money, to pay it off periodically. So, you know, if you can handle it, then that's an okay thing to do. I've done it myself. It's okay. But I never ran into having to pay interest because I make sure that the card's paid off. So it's kind of like a temporary thing that I do. It might be, for example, where Jasper has savings. It was a couple $100 a month, so maybe he took $100 a month off his savings to pay for this furniture for 5 months. So he has the cash to pay for it. He just doesn't want to pay for it all in a lump sum because he wants to stay liquid. Okay, so that's going to end this section. And we are going to get into credit card management in the next section here. And we're going to talk about and see exactly how interest is added to credit cards and how they come up with that payment every month. And this will become a little more clear when you kind of like seeing the cash in the lady's hands that I mentioned earlier in the video. This might open up your eyes a little bit when you just kind of see things starting to add up over time because it's money coming out of your pocket. Okay, so thanks for joining, and we will see you in section 8.1.